We're half an hour away from the open in Hong Kong, Shenzhen and Shanghai. We're watching the China show. I'm Haidi Stroud-Watts in Sydney.
And I'm Yvonne in Hong Kong. Our top stories this morning. Investors looking ahead to a busy week of earnings and data, including the Fed's preferred inflation gauge. Today's Yuan fix in focus after the currency fell to that 4-month low. Premier Li Qiang downplaying investor concerns about China's debt and property risks as officials front-run positive economic news to support markets. Plus, we check investor appetite and where the money's moving across asset classes, speaking exclusively with abrdn CEO Stephen Bird. All right, quick look at the market action here right now. Certainly, this is coming off of a huge week when it comes to central bank action. And for the most part, it came out slightly more to the dovish side. If you take a look at what the Fed did, obviously with the SMB and what major central banks are saying here about the eagerness to ease policy. And that certainly has left the dollar on the stronger footing here. The Bloomberg dollar index is in some of the highest levels that we've seen in a month or so. And really leaving investors still wondering what this all means for risk assets in particular. But we're still talking about slight downside when it comes to Asian equities. Nikkei 225 still hovering on those record highs, though. But the CSI 300, mind you, did snap out of 5 weeks of gains. So that winning streak coming to an end in some ways. We'll see how sentiment plays out for the rest of the week. But certainly the renminbi very much in focus, which we'll talk about in a little bit. We're not seeing a whole lot of movement across bond markets, although you are seeing the Aussie 10-year down some 5 basis points here this morning. The yen still very much in focus, 150, 131. We're hearing from the top currency official there, Mr. Kanda, talking about they have seen some speculative moves in the market, so they will take action if needed. So we're a little bit on intervention watch here post BOJ, and we're watching very closely what happens across Chinese markets. Meituan earnings very much in focus. We talked about Baidu jumping quite a bit in the ADRs overnight, with some reports in the journal saying that they could be collaborating with Apple when it comes to AI. Here's your setup for the China Open here right now. We're flat when it comes to futures, 231. We're back above 230 at least for your Chinese 10-year yield, and 727. We're at 4-month lows we talked about when it comes to dollar China. Watching very closely that fix, Heidi, in just a few minutes.
Yeah, as you mentioned, Yvonne, the renminbi fix is really key front and center today, particularly as we saw the yuan falling the most in more than 2 months. Ultimately, there's signs that, of course, policymakers and authorities are loosening their vice-like grip on the trading of the currency. That sort of unleashed that slide that we saw and pulled down those Asian peers along the way as well. So after that weaker than expected daily fix, we'll be watching for those levels today as well. We're also watching the property sector as well. When are we not watching the property sector, I should say? But some developments we heard from Premier Li Qiang calling for further optimization of property policies, systematic planning of relative supportive policies. Not a great deal of detail there, but it may stir some hope that more support one way or another will be on the way from policymakers for this deeply beleaguered sector there. We're also getting a few bits of news flow when it comes to the Chinese developer Vanke cut to junk territory by Fitch. We'll be watching for the sort of wash up from that. And Country Garden, a unit of Country Garden getting a partner for one of its projects in Guangzhou. And finally, tech tensions, of course. We're watching Baidu, and also a report that China is shunning availability of foreign chips and servers from government PCs. So some of the kind of thematics that we're watching. And of course, it is a busy week when it comes to earnings as well in this part of the world. Some of the big ones, PetroChina, financials as well, China Merchants Bank, China Resources Land, and some of the big energy players as well, Yvonne.
Yeah, so the big banks will be very much in focus. Oil prices, of course, what does this mean? We did see those Sinopec earnings come through here as well. So we're talking a little bit more about the economy, and we did hear from Chinese Premier Li Qiang downplaying investor concerns of challenges facing the economy. He says Beijing is stepping up policy support to spur growth. Let's get to our Asia economy and government editor, Jill Deese, is joining us now. What was the message coming through from the Premier?
Yeah, I think ultimately what he's trying to say is that these major concerns that are facing the economy, obviously, local debt risks is one, the property sector, massive one. Yes, those are still challenges, but the things aren't really as bad as it otherwise seems. He spent a lot of this speech trying to say, look, things are improving in China. We've recently gotten some economic data that was incredibly positive on industrial output figures, some more improvement on investment as well. So he's really spotlighting some of those. And then he also spent his speech really talking about some of the measures that China is taking to try to shore up other parts of the economy, consumption growth in particular. He acknowledged that consumer price growth is still pretty weak. We saw CPI improve in February, although you were still in this larger trend of, some deflation problems. But he pointed to some efforts to, for example, have businesses and consumers trade in old goods for new ones, other measures that he's kind of taking to try to stimulate economic growth there and consumption in particular. So we did see, I think, overall this message trying to reassure foreign investors that, yes, things are improving in China this year.
And certainly the messaging has been key, right? We've kind of seen this shift in the way that communications are being handled. We're hearing a lot of the good news earlier.
Yes, Heidi, I think that this Li Chang speech is certainly an example of that, but we've seen several instances over the past couple of months where a lot of officials have actually kind of front-run some data ahead of an official release, kind of getting ahead of the narrative there. We just saw this last week with a vice finance minister talking about some budget figures before they officially came out, spotlighting some of those positive numbers. We also saw this earlier this month at the National People's Congress, where you saw the commerce minister announced some export figures that were incredibly positive for China, kind of, again, front-running that idea of things are maybe not as bad as they otherwise may seem, or at least, again, trying to set that narrative tone. It does kind of seem like it's this idea that we're shifting the narrative toward more positive figures in China.
All right, Jill. Thank you, Jill Dees there, summing up what we heard over the weekend as well. And as we talked about the renminbi, still very much front and center here today after the currency slipped to a 4-month low last week. And that followed the PBOC's decision on Friday to lower the daily reference rate by the most since early February. Let's bring in Tanya Chen, our FX and rates reporter, joining us now. If you told me that we'd be well above 720, I would have thought that's a bit swift, right? What's really driving this right now?
Yeah, I mean, last week, PBOC let the yuan fixing kind of weaken to the weakest level since February, which one would think maybe it's not a huge move, but they've been holding this currency at 7.2 for the past, I want to say, last 6 months, maybe like late last year. And it kind of just like sent the entire Asian currency market in a tailwind, right? I mean, Aussie sold off, Taiwan dollar sold off, Korean won sold off. And so right now, today, it's the day after, we are quite uncertain about what the officials are trying to do here. Are they trying to test the market to see if maybe they're going to allow a slight depreciation measures to kind of slowly set in? Obviously, depreciation pressure has been building, right? So we saw with the yen, it didn't move that much stronger after the BOJ. But then also there's considerations around whether or not the ECB and the Bank of England will cut before the Fed, and there's also now talks of maybe concerns around tariffs. There's talks of potentially lowering the reserve ratio requirement again. All of these things are going to be difficult for the yuan.
Tanya, we're also watching the yuan, and of course we're expecting potentially more volatility, but ironically it's the prospects of low volatility and range-bound trading that makes it potentially a highlight for a carry trade.
Yeah, that's exactly what is kind of funny about this timing of everything, right? We saw that the yen, the Taiwan dollar, the yuan were kind of key carry trade funders for the past kind of couple of months. And suddenly you see this big move out of the yuan, and it's kind of creating volatility across all of the markets, even in Taiwan dollar as well. So we're going to have to wait and see and kind of see what the officials are going to do around what we saw in the yuan in the last session. But some analysts are saying that they're definitely going to start bringing back these currency management tools that they've done in the past, tightening liquidity offshore. We didn't see last Friday state banks selling dollars to kind of manage the currency depreciation, so we're going to be looking out for what state banks are going to be doing this week.
All right, Tanya, thank you. Tanya Chen on that weaker yuan, which really has kind of led to that sell-off that we saw in stocks on Friday as well. We'll see if that plays out here today as well. That fix coming through any minute now. Still ahead, how job security is quickly vanishing when it comes to Hong Kong's formerly high-flying bankers as IPOs slump to their lowest level in more than 2 decades.
And before that, Yvonne, we're going to get the macroeconomic outlook from abrdn. Their CEO, Stephen Bird, joining us exclusively next to talk about where investors are moving their money. We are counting down to the open of trading in Shanghai, Shenzhen and Hong Kong. This is the China Show. Good morning. You're watching The China Show. Take a look at the week ahead that we're setting up. And on Monday, we'll be getting US new home sales, of course, incremental data that really adds to what the picture that the Fed is dealing with here and will feed through to expectations in terms of where we're headed next after that pretty dovish meeting that we had last week. Malaysia and Singapore CPI will also be contributing to the data docket here in Asia. On Tuesday, we'll be getting some more inflation numbers out of Japan, and that time it will be the Japan Services PBI. Again, we're focusing on every piece of incremental inflation data to feed through to what the BOJ's next move could be after finally getting that lift off last week. Heading into the middle of the week, we'll be watching inflation numbers on the consumer side here out of Australia. We had, of course, some pretty surprisingly robust, there'll be a lot of question marks over the labour market data we got into the end of last week, so that will help kind of clear up the picture on a macro basis. We're also getting China industrial profits, and headed into the end of the week, core PCE, that'll be a key one for the Fed from the US. We're also getting GDP numbers, and rounding out the week, inflation on the consumer side from Tokyo, as well as IP numbers out of South Korea, Yvonne.
Yep, certainly a lot on the backdrop here. And really, let's talk a little more about asset management overall, facing some range of headwinds, including high interest rate environment. You have geopolitical tensions. And our next guest can give us insight on the challenges and opportunities developing right now. Let's bring in Stephen Bird, CEO of Aberdeen, joining us exclusively here in Hong Kong, where he's visiting for client meetings as part of his North Asia tour. Stephen, it's great to have you here in the region. We're just coming off of a big week of central banks, and it seems like, at least in the developed world, they're eager to cut rates now. On the flip side, in this part of the world, we have a China economy that's still waiting for more signs of green shoots. I mean, how do you look at client demand here right now? What's that telling you about the investment landscape?
Yeah, well, that's really why I'm here, meeting institutional investors, banks, insurers, and pensions. And we're seeing a world where there is policy divergence. You mentioned that. We had the US, dovish calls out of the US, Canada, Europe, UK. But we saw the Bank of Japan tighten for the first time in 17 years last week. So we're actually emphasizing income strategies for our clients for the reasons that rates are coming off. There's a divergence between growth, and there's high geopolitical risk in the world. So we think that we are well positioned across dividend-paying equities, across fixed income, and also across alternative investing. And in this type of environment, there really is a role for active investing.
I mean, how do you look at just overall a Fed is looking at maybe a higher neutral rate? I mean, given just the resilience in the economy and all that, I mean, is that meaning lower future returns when it comes to fixed income?
Well, we do think that last week Jay Powell's narrative was very interesting because he really signalled that they understood more about what was going on in the jobs market. So their jobs were immigration has been 1.5 million above trend line, and he really pointed at that as the reason why there was such a strong labour market, because it may have been unusual to say that we've got higher growth, inflation came in a bit hotter, and unemployment was down, but we are still confident that we can cut rates in the summer. And that was really because we believe that they understand what's going on in the labour market. Now that should augur well for the equities. So we know that when we're in the second longest pause right now since in the post-war period. The last time was 06, 07. This pause between the last rate hike and the cut is actually normally good for investing.
Okay.
Now, what's very interesting, sitting here in Asia, is that after the first cut, emerging markets in Asia tend to have outperformance versus the US from an equity standpoint. So it's sort of almost darkest before the dawn, but we do think that as rates come off, that we will see a significant bid for EM.
Hold on a second, Stephen. We do have that renminbi fix just crossing the Bloomberg. As you're seeing, there's a big move when it comes to dollar China here. A bit of a drop here. 709.96. That is the strongest fix there versus estimates this year. So after what we saw on Friday, it seems like we're seeing the central bank come through with a little bit more when it comes to support for the currency here. So that's why you're seeing a bit of a reversal here. But we're still hovering around that 725 level for dollar China, which is still that 4-month low. It brings me to the China discussion then. Stephen, of how clients are looking at China now? Is there more allocation towards or less this year?
Well, right now, I think we're reaching peak pessimism. You can think of investing in China right now as a contrarian bet. Valuations are incredibly compelling. Interestingly, our holdings in China, we've been investing in China for a long, long time. Last year, earnings growth in our holdings was 23%. Earnings growth in our holdings this year we're forecasting to be about 21%. So we do think that, I thought that Kristalina Georgieva's comments yesterday were true, that there's a fork in the road, and we are seeing leaders move more quickly, and I think that's a positive thing. Release data more quickly, that's a positive thing. Still the second largest economy in the world. I think the urbanization focus, which came out from Premier Li yesterday, that half the population still don't live in cities. Every 1% increase is 14 million people. So we think that the fundamental drivers, the real issue is confidence. And confidence has got to come back, and domestic confidence has got to come back. You look at China today has the highest savings rate in the world, 46%, household savings in the mid-30s, and that reflects a lack of confidence. People spend when they're confident. So we think that our clients are looking at that, and we're looking at that. It's very important that confidence comes back. When people feel more confident in the future, you will get the demand which Premier Li is really wanting to stoke.
Stephen, is confidence an issue for your business as well? Because we see costs remaining stubbornly high. The share price has fallen by about a third, and assets under management continue to underperform, both on a 3- and 5-year basis compared to previous years. How much longer do you need to turn the ship around?
So great question, Heidi. Of course, you've got to look at it in the context of asset management, active asset management, the industry. You'll see that if you actually compare the trends within the industry, then they are more favourable. We just reported that we were able to hold our earnings within 5% of the prior year. However, that was because of the investments that we had made in the UK savings and wealth businesses. So our platforms and wealth businesses that generated very strong profitability last year, that diversification helped the model. Within our active asset management business, which is our core business, we've refocused on specialist equities, fixed income and alternatives, and improving performance and a more efficient business. I made a commitment last year that we would reduce expenses by 75 million. We exceeded that to over 100 million, and we are in the process of transforming the business still to be a more efficient investor that delivers good outcomes for clients. I would ask the question, if you're not transforming in active asset management today, if you're not reallocating capital into higher growth areas and into areas such as higher margin areas, such as wealth, then you're going to have a lot of difficulty in the future. We are 3.5 years in. The board told me it would take 5. I was hoping it would take less, but the reality is that we are highly energized and mobilized, and our team today is executing well, and I'm sure that we'll deliver on our commitments for 2024.
In the meantime, though, the unfortunate reality is that a lot of investors have headed for the exits, right? You've ruled out a breakup of the business, but a lot of these investors are saying the only clear investment case would be something seismic to that. Is that something that you might reconsider, or something else that's more dramatic?
So I think a breakup is a really lazy answer. The day after a breakup, you still have all of these colleagues, you still have $500 billion invested, you still have all the end investors, pensioners who expect to be able to retire with a healthy pension. So I don't think that a breakup you describe as an event. We don't consider a breakup to be a sensible thing to do at all. We think the business is very undervalued. Part of the challenge has been that we are a large emerging markets investor. Now, emerging markets have underperformed. Global institutional investors are 7% underweight in emerging markets. Now that will turn. I highlight that when rates come off, and interest rates in the developed world come off, and all developed world central banks are signaling, dovish intent, probably June being the first cuts. Historically, EM tends to outperform after that happens. So goes EM. Aberdeen is influenced by that. Yeah. So our team on the ground here are very focused on serving clients well and in ensuring that when those rotations and allocations occur, we are ready to receive them.
What does that mean then if there's no breakup? What other scenarios are you considering there to bring your profit margins where they need to be? Is it more job cuts?
Yeah, so we announced, Yvonne, a transformation program which did include job cuts. Yeah. We're not alone in doing that. Many active asset management businesses are focused on margin. The group has got three businesses: active asset management, yeah, advisor, and the personal business. The latter two being UK investing businesses. And those businesses you can think of as delivering high earnings and sustainably good margins. The key, the isolated challenge, is getting our investments business back to positive flows, and that's about having the right products that perform well and that can operate with an acceptable margin. The programme that we announced, £150 million of transformation, we are confident will restore that margin within the asset management business. And then you have a modern investing company. Yeah. And we think a diversified modern investing company that is content and distribution is a better business than a monoliner.
Investors still don't seem convinced. I'm looking at David Harrell from Harris Associates. Obviously, just said that they sold the stake in Aberdeen last year because it lacked the confidence in the management to repair the business. Do you think you have the proper management in place to see this through?
Well, we absolutely do. I mean, Harris were a very small investor in Aberdeen. Our major investors, who we are very close to, understand the transformation programme. We have renewed the entire top team. We had a new CIO, Peter Branner, who's coming up to his one-year anniversary and has made very good progress. We got our new CFO just 4 months ago, Jason Windsor, and he has made a very good start. So we've renewed the whole team. These types of transformations, particularly in the face of tech disruption, which is what's going on with active asset management, they do take time. But we believe that the hard work of building a sustainable business is better than the lazy answer.
Stephen, thank you so much. Stephen Barrett there, CEO of Aberdeen, joining us here in Hong Kong. We're taking a look at when it comes to this fix. Of course, certainly we're seeing quite a bit of move when it comes to the renminbi here this morning. So the fixing was a stronger level than what we saw from Friday, and one of the strongest we've seen actually versus consensus for 2024. So that certainly is helping at least support the renminbi and put a floor on this after the swift sort of weakness that we've seen and depreciation of the renminbi here. We're still trading around 725 here this morning, Haidi. So does that impact the equity market? That certainly is where we saw the wobbles on Friday. We'll see if that continues on this Monday morning.
Yeah, and it's very interesting to be talking about a bit of volatility around the yuan fixing, the yuan trade. Right, take a look, Yvonne, at some of the stocks we're watching so far in the very early part as we get into kind of pre-trading there ahead of the open. Meituan will be one to watch. That already indicated quite a bit higher there. The fourth quarter results beat. Cost optimization has been in focus as well. Better than expected revenue and net income for the fourth quarter, with management really doubling down on those cost cuts. We're also watching Sinopec as well. Some of these will be sort of earnings related news flow as well. The 2023 profit falling 13% on the back of oil prices, and refining, though, hitting a record. We'll be watching some of those other names, PetroChina and China Merchants Bank, when it comes to earnings. Also watching Baidu and some of these Apple suppliers. Apple in talks to use Baidu's AI in Chinese iPhones, according to a report. Yvonne.
Yeah, that'd be interesting, right? How does the U.S. look at a potential collaboration between Baidu and Apple when it comes to AI? Meituan raised overweight at JP Morgan, certainly one to watch in that street wrap here today. We got the open coming up next. This is Bloomberg. All right, welcome back. You're watching the China Show. So it was that fix that is what we're fixated on in some ways here. So it is back below 710 again. That's helping to support the renminbi here this morning, Haidi. So it's a proper question whether they were just kind of testing the market about how, this yuan weakness and the like here. Maybe they've kind of flipped the switch a little bit more here today in terms of favoring the currency and supporting it in some ways. But certainly maybe that could help this equity market here on this Monday morning.
Yeah, what does it mean for kind of this emerging yuan carry trade as a base of sort of stability and range-bound trading, right, if we start to get more volatility? But volatility is certainly always expected when it comes to these markets. We're, of course, heavy into earnings season. Still a lot to come, though, in terms of what we're expecting today. PetroChina, China Merchants Bank, and a couple of the energy names, just some of the ones we're watching as we head into the open. And this is, of course, property will be really keenly in focus as we had some pretty sort of vague, I guess, remarks from Premier Li Qiang talking about the optimization of supportive policies for the property sector. Not a great deal of detail, but certainly perhaps that will be enough to give a little bit more confidence that some support will be on the way. We had him really downplaying investor concerns about some of these economic challenges. But taking a look at what we're watching in the day's trading session, Meituan is one that was indicated to be quite active ahead of the open there. We are seeing, watching that as it comes online is on the back of some robust, better than expected earnings there. We're also watching some of the tech names, the Apple suppliers in particular, on the news that Apple is in talk to use Baidu's AI technology in Chinese iPhones and other devices within the Chinese market, according to reporting, and that would be a huge win for the domestic search leader, which has been coming under some pressure in its business. Baidu is up by 1.3% at the moment, and watching for a little bit of downside there when it comes to some of those Apple suppliers. But of course, we know that the Apple story in China has its own idiosyncratic weaknesses at the moment, Yvonne.
Yeah, certainly there's still a lot up in the air. This may not even be something that's confirmed just of yet. So certainly we'll see if that all plays out when it comes to that Apple story. But Meituan certainly having a great day here today. For more, let's bring in our Asia equities reporter, Charlotte Yang. Talk us through what we're seeing across these markets here right now. We got to focus on the currency and, of course, earnings.
Yes, so today is going to be a big earnings day because, we're starting with Meituan. We're seeing the revenue as well as net income beating estimates, and investors are applauding the management's efforts to cutting costs. But then we're also seeing some weakness in the energy names, starting with China this co-producer that's seeing some weakness there, and also with Sinopec, which is one of investors' favorite earlier this year because of their dividend efforts. And then for the broader market, we're also watching where the yuan will go today because Friday's session we saw the weakness in the currencies were actually a headwind that hurt investor sentiment. So yeah.
One of the other sectors that you're watching today is EVs.
Yeah, so we're also watching if there will be any negative read across, from Tesla, which is among the leaders of selling electric vehicles in China. It's reported that they're cutting their production for cars in China. And as we know, the sector has been surrounded with price wars and weakness in growth. What the leaders been doing could be seen as a negative, catalyst for the other players in the sector.
There's going to be a lot of earnings on the property side, Country Garden, the like, some of the big names. Yes. Is that going to be a big headwind for investors here? I mean,
how Country Garden as well as Vanke will report later this week is definitely a key thing everybody's watching because, even though we have this more policy support news coming from over the weekend, it's very clear to investors the authorities want to support the sector. But what hasn't really turned is, we're still seeing property prices falling. And on more of those earnings results, I think will show investors how it's actually hurting the developers from the weaker ones to the relative stronger ones like Vanke.
All right, Charlotte, thank you. Charlotte Yang, there, our Asia equities reporter. And as you mentioned, of course, we're in the thick of earnings here right now when it comes to Hong Kong as well as in Greater China. U.S. earnings are going to start next week as well. So where we are right now, so if you take a look at where the pulse check of earnings and we're looking at here, we'll look at movers first, guys. Meituan is up close to 8% here right now. So certainly that earnings beat is really lifting this market. Apple suppliers, though, are definitely on the back foot. You take a look at CTech, and Sunny Optical. But this is where we are when it comes to the surprises that we've seen, right? 22% of MSCI China has actually reported earnings that most companies actually missing on their estimates as well. So certainly that dictates what this whole sentiment is like. This is obviously the last sort of, I guess, missing piece of what has been a pretty stellar equity rally, barring last week as well. So this is what we're looking at. Right? So Country Garden Wonka, Charlotte mentioned, Logan among the developers here. We're watching Kaisa as well. Sino-Ocean. So all the big names that you obviously have heard of and has been part of the news flow is certainly going to be reporting. Let's get more now from our breaking news earnings specialist, Rachel Yo. Let's start with the property side of things. What are we expecting in terms of the earnings side of it?
Yeah, we are seeing two major troubled developers, China Vanke and Country Garden, reporting this week. So both of them have been facing sales plunges and then losses as well. So for China Vanke, even though they did secure a loan to avoid, it's a default, property woes is still shaking investors' confidence as well, because investors have earlier regarded the firm to be one of the more stable players in the Chinese property sector as well. And then for Country Garden, we are going to see losses deepen as well. So their cash crunch is also not looking very good with falling sales as well. And earlier they also received. So a Hong Kong court had ordered, had received a creditor's petition to wind up the company as well. Yeah. So the earnings outlook for both of these major developers, they are not looking good for the Chinese property sector. So their earnings will sort of give a look on how, that the property sector is at the moment.
And of course, a lot of these banks that do have exposure to this property market are also going to be reporting. What's expected there?
Yeah, so earnings for major China banks like ICBC, BOC, Agricultural Bank of China later this week. That will also give an idea on where the property sector is heading as well. So earlier on, many of these major Chinese banks, they maintain their benchmark lending rates, and then also loans also grew the slowest on record in February, despite earlier easing of the fiscal and monetary steps. So we're seeing real estate troubles hitting these Chinese banks as well. So in terms of like individual earnings wise, ICBC, they may see stagnant growth with such troubles, and also because of the stagnant economy. And then banks like Bank of China and also Agricultural Bank of China, for example, they will also be reporting low single-digit growth as well. Yeah.
Watching BYD reporting earnings as well at a time when the car maker is really discounting more aggressively than ever.
Yeah, so we are going to see BYD doing relatively well for this year. So BYD may see more focus on its market share and volume, as we can see the competition in the Chinese EV sector heating up really well. And then, but their profit is still expected to remain solid because of their exports and also their premium branding as well.
All right, Rachel, thank you. Rachel Yo there, setting us up for what to expect in terms of earnings here this week. Our breaking news earnings specialist there. Some corporate stories that we're tracking for you. DiDi's fourth quarter revenue rose to almost $7 billion. That's up 55% from a year earlier, and shows a gradual recovery for the Chinese ride-hailing leader ahead of a planned Hong Kong listing this year. DiDi has been losing market share since 2021, when regulators launched an investigation into its data handling and forced it to delist in New York. Sinopec's annual profit declined 13% as oil prices fell and Chinese refiners posted a record year for processing and imports. China's largest fuel processor reported $8 billion in net income for last year. That's compared with $72 billion in 2022. Global oil prices were 17% lower in 2023, reducing the value of Sinopec's drilling output. Apple has reportedly discussed using Baidu's generative AI in iPhones and other devices within China. That's according to the Wall Street Journal. Apple sought a local partner because regulators there must vet all AI models. Bloomberg earlier reported that Apple held discussions with Alphabet and OpenAI about using their artificial intelligence software on the iPhones. Apple can tap multiple partners, as it does with search in its web browser. Apple CEO Tim Cook has revealed plans to invest further in supply chain, stores, and research in China. Now, state media says he made the promise in a meeting with the Commerce Minister Wang Wentao. Cook also spoke at the annual China Development Forum, saying AI will be an essential tool for helping businesses reduce their carbon footprints.
We would not be able to recover the level of material that we do today for recycling without AI. I mean, it's already fundamental in our calculation, and I think it provides an enormous tool in the toolkit for every company that's wishing to be carbon neutral or to lower their emissions by a substantial amount.
All right, we got plenty more ahead. Of course, take a look at these markets here right now. We're still seeing a Hang Seng in positive territory. Onshore, though, we're seeing a little bit of negative on this Monday morning. But certainly, what's been hot? It's been the weather. It was the hottest day yesterday, or hottest March we've seen in 140 years, at one point hitting, 31.5 Celsius for those of you in the other part of the world that use Fahrenheit, 88.7. That's hot. That's hot. We got plenty more to come. This is Bloomberg.
Take a look at how we're faring. We're just about 10 or so minutes into the start of trading in the cash session. You see the CSI 300 seeing a little bit of downside, about 0.2% there. We were watching to see if there was going to be much support for property stocks in particular after some intended to be comforting remarks, I'm sure, from Premier Li Qiang about more supportive policies and optimization of property policies. But we are seeing actually real estate, at least trading in Shanghai, down by about 0.6% at this point. We're seeing a few green shoots when it comes to energy names. 0.5% higher. We had numbers out of Sinopec and more out of PetroChina expected as earnings season rolls on as well. Hang Seng just keeping his head above water there. We're seeing tech stocks unchanged. We've been watching some of the Apple suppliers in particular on this report that potentially the company is in talks to use Baidu's generative AI intelligence in its iPhones and other devices within the Chinese market. Hasn't been confirmed, but would be a pretty big deal for Baidu if that turns out to come to fruition. We're also watching dollar China trading at the moment at 7.19. We have really seen a little bit of an edging higher for the yuan. The PBOC setting that stronger than expected fixing this morning. So managing to kind of shrug off some of Friday's pretty significant losses there. We have had, of course, Yvonne, some jitters on these expectations of the loosening or the experimentation of more flexibility there.
Yep, certainly is. And but at least we're seeing a stronger renminbi here today, 7.19 for your onshore rate, which is at least stabilizing the currency here after that fix here this morning. Let's talk a little bit more about some of the news that we were overheard over the weekend here with Russia. Has held a national day of mourning for 137 people killed in Friday's attack on a Moscow concert hall. Russian officials have continued to suggest a Ukrainian role in the massacre, even after the Islamic State claimed responsibility. Let's bring in our Bloomberg reporter, Bruce Einhorn, with the latest on this story here right now.
So, Yvonne, the latest is, according to Russian media, 2 of the 4 suspects have admitted their guilt over the weekend. President Putin spoke over the weekend, and he didn't directly accuse Ukraine. He did say that the suspects had been prepared to flee to Ukraine. He said that there had been a window prepared for them. The Ukrainians, for their part, have denied any involvement in this and have said that this was a false flag operation on the part of Russia. President Zelensky made a statement like that, as well as the foreign minister from Ukraine. And the other thing, of course, is that the United States had said earlier this month, had shared information with the Russians about a possible attack. The U.S. Embassy had even issued a warning on March 7th that an attack was possible from extremists. At the time, the Russians ignored this. President Putin, just a few days ago, had dismissed that as essentially propaganda from the Americans.
And the fact that President Putin still seems to be blaming Ukraine, or at least hinting at that, What does it tell us about his true intentions of where this war is headed next?
We do know that there was a big barrage of Russian missiles attacking Ukraine over the weekend, one of the largest of the war. The Russians do sense opportunity in Ukraine because of the inability of Ukraine to get ammunition from the Americans. That's been held up in Congress. Just recently, the Kremlin has started using the word war to refer to this. Up until now, it's been a special military operation. Now, President Putin's spokesman has used the word war, so that could be an indication that there's a change in the way that they're approaching this. There may be a change in the way they're trying to get more support from the Russian population to the war. How all this ties into the fallout from this terrorist attack, we still have to see.
How much more mobilization could we see from Russia, and potentially if this is kind of being used in terms of the attack that we saw over the weekend and the connection that's being made? Or is there a sense that really Moscow is waiting to see what happens after November and how much support Ukraine can continue to get from allies?
You do make a good point about the November election in the United States. Former President Trump, the likely Republican nominee, has in the past not expressed a lot of support for Ukraine. The Republicans in Congress aligned with former President Trump have helped to hold up additional aid to Ukraine. So there is a possibility that Putin is looking ahead to that and a possible major shift in the balance in terms of what sort of support that the Ukrainians are going to be getting from the Americans. As far as any what we should make of statements from Russia at this point, Chancellor of the Exchequer from the UK, Jeremy Hunt, did say over the weekend he accused Russia of what he called a smokescreen of propaganda related to the attack, the terrorist attack. He also said we have very little confidence in anything the Russian government says.
Bloomberg's Bruce Arnholm there with the latest. Some of the other geopolitical stories that we're tracking this hour, and the Philippine military says a Filipino civilian boat was severely damaged on Saturday, with some crew members injured when 2 China Coast Guard ships fired water cannons. It says the Chinese ships deliberately targeted the vessel, which was on its way to resupply Filipino troops stationed at an outpost. It is the latest in a series of confrontations between Chinese and Philippine boats in the disputed waterway. U.S. Vice President Kamala Harris has declined to rule out consequences for Israel if it invades the crowded southern Gaza city of Rafah. She told ABC News Washington has been clear in multiple conversations with Israel that a major military operation in the city would be a huge mistake. But Prime Minister Benjamin Netanyahu has rejected U.S. warnings about attacking Rafah, where more than 1 million Palestinians have sought shelter. Well, coming up next, how job security is quickly vanishing for Hong Kong's formerly high-flying bankers as IPOs slump to their lowest level in more than 2 decades. This is Bloomberg.
Our big take here this morning is really focusing on some of these once high-flying Hong Kong bankers now becoming a bit of a lost generation here. Of course, we're talking the ones that have Chinese expertise that were highly sought after in Hong Kong maybe about 5 years ago. Now we're talking about job security that's vanishing as IPOs are slumping to their lowest since 2001. For more on our big take here today, let's bring in Lulu Chen, who leads our Asia investing for Bloomberg News. She joins us now. I mean, what's sentiment like? Sounds quite dire.
The key concern here for these bankers is whether the downturn that we're seeing, is that a cyclical change or more structural? And the concern is that this booming era that we've Chinese companies with global capital markets in Hong Kong and New York that formed a $6 trillion trail, would that be coming to an end? And is this the end of the good days? Not everyone is convinced. Some think that this is only a brief downturn that could come back. But as we're seeing the layoffs come into the market, and recruiters say that there are hundreds of bankers now on the search for for jobs, people are really concerned about their short-term job securities.
And it seemed like, anyone that spoke Chinese, had that expertise, this whole kind of idea of having tighter ties with the mainland was always going to be a benefit. What do you think has changed the most?
Well, most shocking to us, the psychology, a lot of these people, the financiers working in this industry, is that they thought this was the norm. And as we've seen in the changes in the past few years with the tightening scrutiny of data, security, and also the shrinking of the IPO pipeline right now, and the scrutiny of Washington against Chinese companies and capital, whether, that model is now broken.
Well, especially when you take a look at how much financial services makes up the broader economy, right? About a quarter of economic growth relies on it. Is this kind of going to be part of the new normal as we continue to see the structural slowdown?
Not all people are convinced that this is the new normal, and some are saying that what financial market participants need to do is toughen up and wait for the next boom. There's a lot of factors at play here, especially from the policy and geopolitical aspect of things. So lots of things up in the air right now that people need to wait for and get more clarity, especially running into the election year.
All right, Lulu, thank you. Lulu Chen there, who leads our Asia investing team, and make sure to check out that big take here today on, of course, the prospects here for Hong Kong bankers. You can tune into that story and more in your newsletter, of course, Hong Kong Edition, that comes out every Thursday as well. You can head over there to Bloomberg.com to check it out. And NI Big Take for that big story as well, Heidi.
Yeah, and Yvonne, of course, we can get that insider's guide to money and the people shaking up the finance hub in our new Hong Kong edition newsletter. That's out every Thursday. You can sign up via Bloomberg.com/newsletters. Let's get you back to the markets in terms of how some of the key stocks that we're watching are trending at the moment. Meituan is obviously a big one, as we saw really that jump after the fourth quarter beat. The price target seeing a number of upgrades as well. 7.2% is how we're faring at the moment. We have really seen better than expected revenue for income as well for the fourth quarter, and a lot of the management efforts when it comes to cost cutting being highlighted by analysts who have been quite impressed as well. And we saw a number of brokers raising their target. Also watching some of the car makers. BYD ahead of earnings, softer by 1.2%. There's a lot of aggressive discounting going on. But more broadly, the EV sector may be reacting to this story of Tesla trimming their car output in China, as well as we see that slowdown in their EV sales growth there, Yvonne.
Yep, and this is what your dashbook is looking like when it comes to some of the major benchmarks here. The Hang Seng is pretty much flat. We're erasing some of the initial gains here. MSCI China and the CSI 300 are still in negative territory. HSTech is on offer, and we're watching very closely what goes on, as you talked about, the tech space. That rebound, though, in the renminbi, not really doing too much to really help with sentiment here this morning, but we're still talking about 724 for dollar China. Your Asia benchmarks are looking like this here right now. We're still slightly on the back foot here on this Monday morning. We're down about 1/3 of 1%. U.S. futures flat. This is Bloomberg. Welcome back to the China Show, hour 2, and we're looking at the CSI 300 doing this here right now. We're just slightly on the back foot on this Monday morning, just a half hour into the session here right now. Not a whole lot going on. Obviously, we're waiting for a lot of earnings to play out in Hong Kong as well as in Greater China here this week. The property developers are certainly one, the banks. So quite interesting in terms of what could actually dictate sentiment throughout the week here. Also, this rebound in the renminbi, just given the fix that we saw here, maybe that helps clear out some of the concerns about whether the PBOC was on a bit of a weakening bias when it comes to the renminbi here today. But we'll see, Heidi.
Yeah, a pretty significant move when it comes to trading in the yuan, and does that kind of kill off the volatility that we've seen going into the end of last week. But of course, FX markets more broadly pretty interesting. We always also had that very robust message of warning from Japan's currency chief as well, Yvonne. And take a look at how all of this is playing into broader markets. As Yvonne mentioned, we're still in the thick of earnings in China. But of course, we're also looking to some of the macro data, and for the Fed and for some of these other central banks, it's a big week of inflation. Key inflation readings from the US, also through in Australia, across Europe as well, will be really critical in terms of tracking the trajectory for some of these central banks and the way forward. And in fact, we've got Japan Services PMI on Tuesday, so potentially also adding a little bit more colour around expectations to really where does the BOJ go from here after finally attaining liftoff. We're rounding out the week with Tokyo CPI as well, always a good leading indicator to watch. Let's bring our MLife strategist, Mary Nicola, who's with us. And Mary, I would say that the sort of key focus of this Monday morning has really been trading across FX markets, right? Let's kick it off with what we're seeing with the yen. We're seeing certainly a lot more reaction from policymakers in Japan now.
Yeah, and that's a key message that we get not only from Japanese policymakers, but also from the policymakers in China, is that FX is not a one-way bet, and they don't want to see much greater weakness in their currencies from here or greater speculation. So obviously we'll see a lot of two-way volatility in the meantime, but it's hard to see these currencies really break free when you've got two conflicting and opposing forces coming through. So fundamentals remain on the side of currency weakness, while the policymakers are suggesting that they don't want currency weakness to go further, or that they want a two-way bet. But that internal struggle is going to continue, but fundamentals are likely to dominate, which will likely keep the currency weakness continue.
And when it comes to the renminbi, I mean, do you think the PBOC was a bit concerned about this yen weakness in some ways? I mean, what do you make of the fixing today?
Yeah, the fixing today was a clear indication that they were not happy with the market reaction on Friday. And Friday's market reaction was that once they pushed the CNY fixing above 710, the markets just took it and it included further weakness on the CNY. But the key thing here, especially for the CNY, is that it's not that it's this lone soldier that's just weakening on its own. It's more or less moving with broad dollar strength, and where we're seeing the other Asian currencies. In addition, if you look at the way the CNY is moving, let's say against its trade-weighted partners, it's actually been appreciating since the start of the year. So it should temper some concerns about excessive weakness in the currency in that sense. But at the end of the day, it's that dollar CNY that keeps being watched very closely by traders, and that is going to keep policymakers on edge.
Yeah, particularly as we get the Fed's core preferred gauge of inflation this week, as well as inflation readings out of a number of other economies, including Japan. But the direction for the dollar, have we kind of seen the path being set, particularly against the yen, which, even as we saw that for other currencies, a one-way bet for the dollar, the yen kind of still traveling in its own direction after the BOJ.
Yeah, it looks like the dollar trajectory is still positive, and we're likely to still see dollar strength going forward. If you look at the PCE numbers this week, there's likely to be more suggestion that CPI and inflation is not going away anytime soon, and so that it's not going to find reassurance or reassure policymakers that they are ready to cut just yet. So the dollar is likely to see another leg higher and see some support on the back of that, especially since the PCE numbers, we already know that they'll likely be hotter than expected, with both CPI and PPI numbers were on the stronger side. So the dollar trajectory looks still quite positive, and we're likely to still see that dollar momentum going through.
Mary, thank you, Mary Nicola there, MLife strategist joining us out of Singapore. Coming up on the China show, signs of fresh support may be on the way for the country's troubled property sector, with the premier calling for systematic and supportive policies. But first, how a draft U.S. bill is taking aim at some major Chinese biotech and genomics companies. We'll be speaking with Bernstein on the outlook for the pharma sector. Next, this is Bloomberg.
A draft US law is casting a cloud over some Chinese pharma firms. The Biosecure Act aims to block certain foreign biotech companies from accessing US federal contracts on national security grounds. And among them is WuXi AppTec, which US lawmakers accuse of being a PLA-affiliated company. They manufacture medical products and supply essential ingredients to some of the world's top pharmaceutical companies. And WuXi AppTec generated 65% of its 2023 sales from the United States, and that is now a source of revenue, Yvonne, that is under threat.
Yeah, we've been trying to talk a little bit more and maybe do a deeper dive into this healthcare space, just given the headlines that we've seen, right? And even though the bill hasn't been passed, take a look at the weight it has on the firm here in terms of these geopolitical risks. The Hong Kong listed stock has fluctuated since the U.S. Senate committee advanced the act earlier this month, and shares of its sister company, WuXi Biologics, is also under pressure. Both stocks have lost over half, or been cut basically in half this year, making them the worst performers on the Hang Seng Index. And in an open letter, we did hear from WuXi AppTec calling the U.S. legislation, quote, misguided, and says the firm does not pose a national security risk to any country. It isn't the only Chinese company in the crosshairs, though. For more, let's bring in our senior medical reporter, Michelle Cortez, joining us along with Rebecca Liang. She's a senior research analyst for China, pharma, and biotech at Bernstein. Michelle, I'll start with you. Thanks so much for joining us, by the way. First of all, are they a threat to U.S. national security?
Well, I mean, what a great question, Yvonne. And of course, that's the crux of the entire issue, right? There's two things actually that are happening here. There is the potential threat to U.S. security, national security. Some of the companies that have been mentioned in this bill do things like provide genomic research, genomic work, and theoretically would hold information about Americans' health. Then there's also WuXi AppTec, which does an awful lot of the manufacturing, research and development, that kind of thing. But it's not just the individual health of Americans. There's also the economic benefit. China has really focused on biotechnology as an industry of the future. They want to have a key role. The U.S. completely leads the world in this space, does not want to give an inch. So not only do you have the national security, the personal integrity, but there's also an overlay of economics here.
Yeah, and Rebecca, maybe chime in. Beyond just maybe punishing WuXi in this biotech bill, I mean, what do you think the U.S. is trying to achieve?
Well, I think, Yvonne, there are two different things. We look at the targeted companies. BGI is in genomic sequencing, and WuXi is in the space of CDMOs. They provide capacity for biologics. So I think with the threat, the alleged threat on national security, it's more about the genomic data, the sensitive personal information. Right? But I think for CDMOs, it's quite different. What the politicians in the U.S. have stated is that they would like to keep U.S. leadership in the capacity and supply of of the biologics globally, and they see companies like AppTec and biologics as an emerging threat to that. And interestingly, although both companies are WuXi, they have essentially the same owners. WuXi Biologics have made an earlier move to expand their capacities in the U.S. They now have 10% of their capacity in U.S. in Massachusetts, and by 2026, that number is going to further go up to something like 40%. So, WuXi Biologics, in that sense, it's actually having more stakes or having done more localization in the U.S. versus AppTec, which is more targeted now for not having any capacity in the U.S. at all.
So, Rebecca, what do you think is going to be the ultimate impact here? Do you think that WuXi AppTec and biologics, are they going to have to divest? If it does go through, where do you think it's going to fall out in the end?
I think the ultimate impact depends not only on whether the bill passes. We don't know, right? It also depends on if the bill passes, how it's going to be the result. The result, in my opinion, is I think a hard landing scenario is quite unlikely because the U.S. also has a lot of stakes. We know that public companies like Lilly have stated that they really depend heavily on the contracts with WuXi Biologics. It would be hard for them to switch their supply chain entirely in a very short time frame. So I think now you also see when it comes to the bill itself, there's grandfather clause that exempts some of the earlier contracts. There's also a grace period up to 2 years for it to materialize. Not to mention there are also waivers that you could make. So all in all, I think it would be quite against the national interest of the U.S. as well to go for a complete hard landing, given that these companies do manufacture life-threatening, life-saving medicines, right?
Do you think the stock reaction we've seen has been quite dramatic? Has that priced in already the worst-case scenario then?
Yeah, I mean, the markets really, I think, driven by emotions now. Both stocks are down over 50% year to date. Our colleagues at Bernstein who do cover WuXi Biologics think that it's already beyond the worst case scenario. But I think it's emotions are everywhere, and it seems the market is trying to figure out what is exactly the worst case. And I think what the capital market is is deciding at this point is a bit decoupled from the actual business sense, which is going back to how a hard landing case is not in the best interest for both China and the U.S.
I mean, it goes with the timing. I mean, are the bills going to pass, for one thing? How long do you think it's going to take, and what are the pros and cons around the timing, Michelle?
Right. Well, I mean, whether or not the bill is going to pass, this is one of those things where we're trying to read the tea leaves on American politics right now. I mean, it's a nightmare. I don't know. I'm glad I'm not covering that all the time because what they're doing over there is crazy. This is one of the very few areas where there is bipartisan agreement. Everybody wants to come down on China. They definitely don't want to give an inch. So there is collaboration that we haven't seen across any other industry. That being said, Republicans do not want to give Joe Biden any type of a win coming into this election year. So perhaps there's going to be some pushback there. We don't know. It's definitely going to take a couple of years. Yvonne, the other thing we haven't talked about, although Rebecca did touch on it, there is huge ramifications for the global pharmaceutical supply chain. Yeah. That means if you're taking obesity medicines, if you're taking Lilly's obesity medicines, and we do have a hard landing, it's tough to get them now. It could be impossible to get them going forward. It is not possible to overestimate or to overspeak how important this industry is to the U.S.
And Rebecca, maybe you can add to that. I mean, if this law goes into effect, who is it going to impact the most? Is it some of the big companies, or are we talking some of the small ones? Are we likely to feel it from the consumer as well?
Right. So as of now, the named entities are just genomic, BGI and WuXi AppTec. AppTec, there's no public information to support this, but it's widely accepted that they do have a big order from Eli Lilly. And this goes to what Michelle was saying, Zepbound has been launched a couple months ago, and Lilly has repeatedly said that they're going to face supply difficulties. Although they're building their own large expansion, it's not going to be in time for the next 2 years. And so I think for sure GLP-1s, the shortage would continue. Not to mention that there are more serious medicine, like in oncology and other life-threatening cases than just obesity meds.
So, Rebecca, it's not even just, though, WuXi AppTec, because the bill is supposed to be looking at a whole host of other companies, right? They're going to ask the government to weigh in on different things, and that could be weighing on the China biotech healthcare sector as well. Last year wasn't great with the crackdown on corruption. Now this year we're having this geopolitical fight. What do you think about the broader healthcare industry in China and Asia in general?
Right. So the bill definitely, in terms of named entities, it's limited, but we know that there are blanket statements that could affect the whole space of China biotech and CDMOs. I think that we see that stocks of biotechs in China, in a way, they have been dragged down also by this whole WuXi story. In terms of headwinds, there's times are tough for China biotechs. We know that the indices are down for some time. But what we're seeing now is some of the headwinds earlier, they're dissipating a bit. For example, the overhang of the anti-corruption campaign that's been in effect since last year. We see the result is limited in terms of the drug sales that's coming out. In the third quarter, it was only down 2%. on the industry average, and on the fourth quarter, it's supposed to be even better. We also see that leading companies, they can totally survive this better than others. Innovent, which is in our coverage, they reported over 30% growth even in the second quarter of last year, even amidst the campaign. So I think the headwinds are a bit, gone compared to before. Also, we see signs of recovery. Investment that goes into clinical research in the form of a number of new clinical trial starts. They have been in straight decline for the past 2 years. But starting from the end of last year, we also see an uptick again. Right, so I think the fundamentals of the industry still look very strong. In a way, what's triggering this whole political drama is that China has indeed been advancing on the innovative drugs. A few years back, when we started the coverage, we saw that there was almost no real innovation in China. There was almost 0% drugs called first-in-class. These are, the truly innovative ones. But today, that number has gone up to about 10 to 20% of the entire national pipeline.
And we saw hundreds of bankruptcies within the pharma space just last year. I mean, are you expecting this consolidation in the industry to speed up in any way this year?
Yeah, definitely. We saw the acceleration of bankruptcies, acceleration by about 30-40% last year. I think that trend's going to continue. That's actually good for the industry because we know there's been quite a lot of oversupply in drugs that are more or less the same, the Me Too drugs. But I think now we're seeing that the one thing is the funding drought that's still going on. It's bad news for the tail companies, but we see that the leading players, again, they're able to find other creative ways of financing. For example, last year we saw that the out-licensing deals, which involve these companies selling the overseas rights of their innovative drugs to MNC partners, the upfront payments of those deals have actually gone up so much that they have compensated for the lack of funding from the capital market. So I think the leading players will find ways to get out of this.
All right, Innovent is certainly one of them, according to Rebecca. Thank you so much, Rebecca Liang there, Senior Research Analyst at China Pharma and Biotech at Bernstein. Also, our thanks to our Chief Healthcare Correspondent, Michelle Cortez. We got plenty more ahead. This is Bloomberg.
Some of the corporate stories that we're tracking this hour, and Didi's fourth quarter revenue rose to almost $7 billion, up 55% from a year earlier. It shows a gradual recovery for the Chinese ride-hailing leader ahead of a planned Hong Kong IPO this year. Didi had been losing market share since 2021 when regulators launched an investigation into its data handling and forced it to delist in New York. Sinopec's annual profit declined 13% as oil prices fell and Chinese refiners posted a record year for processing and imports. China's largest fuel processor reported $8 billion in net income for the last year. That compared with $72 billion in 2022. Global oil prices were 17% lower in 2023, reducing the value of Sinopec's drilling output. Chinese Premier Li Qiang, Yvonne, had some interesting, although not terribly specific, comments about the property sector.
Yeah, further optimization of property policies to stimulate demand. That's what we heard. A sign that further support possibly could be coming for the sector as well. Let's get to our bond and loan reporter, Loretta Chen, joining us now on what that means and what we heard from the premier.
The overall message from Li Qiang is quite strong. He talked about all these measures. Of course, that's building upon what the central government has already been doing for the property sector. There's some highlights. For instance, he talked about this systematic planning of support for property sector, especially on the demand side. So, that could mean more loosening of home buying policy that we've already been seeing since last year. So is Beijing going to lose all the home buying restrictions for all the major cities? That could be a key question that people are asking. And on the other hand, he talks about this mixed model in the China property sector of a government-led housing and also commercial housing, while in the past decade, you're mostly seeing this very market-led, market-driven market in China. So that's going to change, and that's a key policy for Beijing.
And I mean, we just came off of this big inaugural event. Sorry. Go ahead, Heidi.
No, Yvonne, I was going to say, we're not so patiently waiting if you're a property developer, right? Vanke being cut to junk for its investment grade credit. So this is going to be, even more difficult when it comes to sales and financing.
Yeah, definitely. I think in the offshore market, Van could eventually be in the junk name, and I think the third rate cut is just in the horizon. It's only a matter of time for S&P, which still has an IG rating for Vanke, to cut that. It will just be a losing more financing channel for Vanke in the offshore capital market. So the only channel that's really reliable for the company would be in the onshore, what kind of bank loans it can receive from these lenders with that call of help from the central government. Are they actually going to extend those credit lines for the company? That will be the key.
Loretta, thank you, Loretta Chen there on what to expect. Of course, we're still waiting. Country Garden, Wanka is set to report earnings this week as well. Could be a big one there when it comes to the results season. You take a look when it comes to the market check here right now. We're slow going, but we're still seeing this Hang Seng at least catch a little bit more momentum around this rally here. We're up about 0.5% for the Hang Seng. When you watch these property developers in particular, China Wanka, we mentioned Country Garden, those are the big ones this week to watch. Long Four is also up with earnings. Ahead of that, we're up some 4% for that stock here right now. So it's a mixed picture across these developers here on, of course, that message that we heard from the premier. In terms of other ones we're watching out for, it's the Meituan. There you go. That continues to be an outperformer here on the back of those results. Talking about the beat there, cost optimization in focus. BAIC are watching the EV sector very closely, just given what we've been hearing from Tesla trimming their output of cars in China, just given the slowdown we're seeing in this industry down cycle. And we're watching very closely what's going on in terms of movers here today. It's a mixed bag, but energy seems to be at least still on bid here today, as well as materials. Real estate is the big laggard. This is Bloomberg.
It is 11:29 a.m. in Tokyo. Japanese markets are going on a break in just a minute, and we are seeing perhaps a little bit of profit taking, given we didn't even see the Bank of Japan and the moves in the yen really derailing any of this record-breaking surge that we've seen in Japanese equities. It is a downside day, as I said. The Nikkei 225 and the Topics both seeing downside of about 0.8% there. But the Topics, of course, were down about 3% from the all-time record high in December 1989. So not too far from those record highs. But of course, some of this profit taking perhaps not unexpected, given that we see that relative strength index for both the Topics and the Nikkei greater than 70. So suggesting that these two markets are still in overbought territory. Well, Bloomberg opinion columnist Mohammed El-Arian says it's still too early for investors to pivot away from US markets, given the country's exceptional economy. El-Arian also told us what he's seeing in the Fed's latest rate decision and Chair Powell's comments.
Initially, we had bottom-up drivers, secular themes that were very powerful. But that rally was narrowing. Now, suddenly, you have a very powerful top-down factor that has come in, enabling central banks that clearly are going to do what they want to do, regardless of selective data focus.
Well, let's talk about the Fed if we can.
These two things coming together are really powerful.
Were you surprised by what came out of the news conference with Chairman Powell?
I was surprised by the extent to which he stressed patience in two ways. Patience with inflation running higher. He basically dismissed the fact that we've had some pretty surprising, hotter than expected inflation prints. And then the second patience with the balance sheet, saying, you know what, we may get there slower than we would have otherwise, which means that monetary policy is going to be more expansionary than it would have been otherwise. So I was struck that on the balance sheet, he took such a big step forward when he could have waited till the next meeting to do that.
So we keep wondering what shoe is going to drop, right? We keep thinking everyone's bullish and then more bullish and then bullish on top of bull. And you have to wonder, okay, well, when does something break? And we were talking on Wednesday, it's the inflation expectations, that at some point this is going to be a higher, more inflationary environment with a Fed that is less willing to fight it. And yet I'm not seeing it in break-even rates. I'm not seeing it in other places that you normally would. Why do you think that is?
You're seeing it in gold. Look at the reaction of gold, record highs on gold. I think what you're having is, and you've all said it really well, the everything rally. So it's going everywhere. what's interesting now is this notion of market enthusiasm, not economic enthusiasm. There's a big difference. Market enthusiasm could spread to the rest of the world. And that is quite a consequential statement. If that occurs, then the U.S. relative strength is going to be somewhat diminished. I think it's actually too early to pivot. I do think that, to use your phrase, U.S. exceptionalism, economic exceptionalism, isn't going to expand to the rest of the world. The U.S. is really exceptional when it comes to its economy. The others aren't doing what the U.S. is doing in terms of investing in the future drivers of growth. They don't have the entrepreneurial society that we have. They don't have the mobility of factors of production that we have. The U.S. is truly exceptional among other advanced economies.
So do you think it's rational for people to stay in the United States and to keep adding more, even if valuations are at such high levels relative to the rest of the world, to continue to kind of bet on this ship and not expect it to expand elsewhere?
So I've been asked that question every single year for the last 5 years. And every single year, the U.S. premium has increased. And every single year I said, don't fade the U.S. too early. I see some argument for diversifying away from the U.S. purely on this enthusiasm and on relative valuation, but I don't see it as strong. It is not being supported by fundamentals. People have to realize this. This is more betting on the momentum. And I understand that. The momentum factor is very strong right now.
That was Mohammed Al-Arian there from Bloomberg Opinion, columnist, speaking, of course, to our colleagues at Surveillance. And you take a look at when it comes to the market setup here after what was a huge week when it comes to central banks, what we heard from the Fed and the rest of the world. And it was more leaning towards the dovish side here. You are still seeing risk assets a little bit on offer here today. We're not seeing a whole lot of conviction. Obviously, we still have that PCE inflation gauge coming out at the end of this week for more clues on what the Fed could do and will they actually deliver on those 3 cuts this year. Certainly is still where the optimism lies that maybe that cut could come as early as June. Let's bring in Martin Henneke, their Asia Investment Director at St. James's Place Wealth Management here in Hong Kong with us. What did we learn last week, do you think? And what does this mean for this whole everything rally that Mohammed had just talked about?
Well, I think one key fact is being missed a lot by the central bankers, politicians, and a lot of major contributors, and that's the really large deficit and debt. We have talked about this quite some time ago already, but it's been accelerating. And so you have to take into account not just US GDP, but the amount of deficits that's being put in there to generate that. But maybe if we cut to the chase briefly on investing, one thing Al-Arian just did mention, though, that he's increasingly open, if I understood that right, to some degree at least of global diversification, and that's certainly something we are quite keen on. If you're looking back a little bit further in history from the year 2002, 2010, S&P was really flat. Emerging markets were flying. I remember in 2010, there were a huge amount of emerging market seminars, Brazil and whatnot. Now people have almost forgotten Brazil even exists. But I think there are some great opportunities in some of the less popular economies at really attractive prices. So don't give up on those and stay diversified, I would say.
I'm just saying in terms of what the Fed highlighted, right? Is this the central bank that you think is a bit more sensitive to maybe now the more downsized risks to the data versus the upsized risk? And what does it have actually implications for the dollar, gold, for example?
Well, I think it's really hard to say. I would say the key bit, just coming to what's missed, and I think it's missed by majority of investors. When you look at the last IMF projection of U.S. budget deficit, they say, well, the next 5 years is 6.5% to 8%. Now, when the Eurozone was formed, which I was very keen to watch at the time as I'm German, there was this limit of 3%. No country could have a budget deficit above 3% or risk being on an unsustainable path. And, I don't think we learned a lot from the comments of those central bankers last week, but I want to give you a quote. I've done that before, but I want to give you that quote again where I think you can learn a lot more from Alan Greenspan, because he's not tied anymore by this politics. So he said, before the inflation uptick in year 2020, just before they come on, give you the quote, he said, unless we bring those extraordinary budget deficits under control, history tells us there's going to be a much more rapid rate of price increases than we have seen. So ultimately, I think they're not talking about it, they're just about, economy, labor numbers. They're not talking about the deficit, and I think the inflationary pressures might still be here to stay much longer and surprise on the upside. So if, as an investor, one can tolerate a reasonable degree of volatility, stay, with a reasonable amount of your assets in inflation-proof things, they are more volatile than cash in deposits, but less at risk of being eaten up by negative real interest rates.
When it comes to Japan, we've seen really the market shrugging off the BOJ liftoff, shrugging off the moves that we've seen, or expectations for the yen. Does that mean this record-breaking rally continues?
Well, valuations have risen somewhat now. The yen is still cheap, so for international investors who haven't hedged, it hasn't gone up all that much. But let me just briefly say it's not the cheapest in the world anymore, so that makes us maybe look again at China, where actually I think there are quite a lot of positive there that's being overlooked. And maybe one thing briefly before coming back on Japan, on China, a lot of people seem to be really disappointed. There wasn't any bazooka being launched to support consumer market in the short term. Yeah. But as was said on the weekend in the global conference by the premier, they are focused more on upgrading the manufacturing, upgrading technology, and in the longer term they think that brings the competitive advantage. But both for China and Japan, I think there are good opportunities in equities. Equities also are one more inflation-proof assets. And I think, for those who are worried about currencies, both the yen and also there was a bit of a wobble, last Friday on the renminbi, I'll just say that, well, we would prefer on those kind of markets to look at equities rather than fixed interest, because if you have companies with an edge in the market, they can just ride on inflation and increase prices in line with the rising input costs.
So we've seen preferential flows head towards the likes of India and Japan away from China. You think it's still important to have China in a diversified portfolio, and where?
Well, yes, absolutely. You won't believe how many investors have been asking us, shall I dump all my China exposure and move it all to India? Because obviously, they say that's the better story and a better investment place. Of course, India has some good factors going, some good macroeconomics, good demographics, which is a big challenge in China and some other things. But, the valuation gap is close to records in terms of the discount of China to India. So don't give up, maintain a diversified balance. Don't go overboard on any one market and economy, however popular. Story often means valuations might be quite high already. Now, within China, one thing that I think is really, really important to be aware of is that when you look at those companies that have a dual listing in the A market and the H share market in Hong Kong, on average, they trade at a 33% discount right now in the Hong Kong market. So that's probably the first bet or the first source there to look at for real good bargains in the Chinese market. They don't necessarily have to be value stocks, could be growth at reasonable price as well.
Yeah, we talk about whether tech is a value play or a growth play now, but you mentioned about the tech space. Everyone's been focused on EVs, new energy. Are you focusing on those sectors, or are you looking elsewhere?
Oh, yeah, there are definitely good opportunities there. In fact, some value managers, if you have been tracking some, they are actually looking at Chinese tech, which is like the first couple of years in history, because some of them are actually trading interesting at reasonable prices. Everybody looks for AI in the United States, but you have some companies that directly or indirectly benefit in Asia from this or other high growth areas trading at very reasonable prices. And the way and speed with which China has been upgrading manufacturing is really quite enormous. In 2022, there's 290,000 industrial robots installed, which is partly to address that demographics challenge. Now, that's 54 times the amount of India, the robots installed there, and about 7 times the amount of US. So just don't count them out just yet.
All right, look at the automation space there. All right, Martin, we're going to leave it there. Thank you, Martin Henneke, Asia Investment Director at St. James's Place Wealth Management, joining us here in Hong Kong. And of course, you can follow major themes in all the day's trading on our Markets Live blog that is on the Bloomberg at MLiveGo. You can get a market rundown in just one click. There's commentary, there's analysis from our team of expert editors, so you can find out what's affecting your investments right now. This is Bloomberg. All right, let's talk Bitcoin. Why not, right? Given what we saw, a little bit of weakness, well, at least you could say a bit of weakness there when it comes to in terms of ETF trading. Turnover seems to be cooling and really falling close to 10% from the all-time highs that were reached just a few weeks ago. And it's really just seen as one of the largest retreats this year. And that's as we start to see appetite moderating for some of these spot Bitcoin ETFs. For more, let's bring in our Bloomberg Intelligence ETF analyst, Rebecca Shin. So have we reached... Are we saying goodbye to the best of Bitcoin? What's next for these ETFs now?
I think there's still hope for them, especially for the U.S. one. So what a lot of people may not realize is in the U.S., the spot Bitcoin has only been around for 2 months, and it's hit phenomenal records. On average, it trades $100 billion in notional turnover. They've reached globally $70 billion in terms of spot Bitcoin. It's at $53 billion in assets under management, and in terms of flow, $12 billion. So by all accounts, the most successful ETF launch ever. And I think this exceeded everyone's expectation. And one of the things we're seeing is that in the U.S., all of the demand we're seeing is purely organic retail demand, is people inquiring. What happens in the U.S. is for the ETF to be sold through the advisor and distribution channel, you need to wait 90 days. So come April, we could see that demand go even further because now people can start selling their products and start soliciting it. So in the U.S., the advisory business is roughly a $1 trillion market, and their estimate is even if you put 1% of that into Bitcoin, virtual assets, that demand could increase a lot. And so I think that there's still room for Bitcoin to go up, and some estimate that it could reach as high as 100,000 or even 150,000.
Yeah, I mean, as you say, it's only been 2 months, right? I mean, what insights are you getting in terms of this Hong Kong spot Bitcoin ETF? Are we likely to see one soon? If so, when?
So in terms of spot Bitcoin ETF in Hong Kong, the SFC actually approved it in December. And so there was a potential race that Hong Kong may have beaten the U.S. in terms of spot Bitcoin. But we could see one as early as May in Hong Kong. And so the person that has filed for this is Harvest Asset Management. They are first to file. But in Hong Kong, there's actually already $135 million worth of Bitcoin and Ethereum futures-based ETF by CSOP and Samsung. And so I think spot Bitcoin could come as early as May, but I think one of the challenges the Hong Kong market faces is that if it's as successful as the U.S. In terms of notional traded, like in the U.S., spot Bitcoin has $53 billion. In Hong Kong, the entire ETF market is only roughly at $50 billion. And so if Hong Kong were to replicate the success of the U.S., I don't think the current infrastructure would be set up for it. And one of the challenges is that the SFC has said all of the custodians needs to be Hong Kong based. So the only one set up currently is Hashkey and OSL. And so I think we really need the big players like Citi and HSBC to come on board to take spot Bitcoin before we can really see a big rise in it. But I think that if, 1, 3, 5 years later, we could see Hong Kong being the hub of Asia for spot Bitcoin ETF.
When it comes to the halving, are we expecting that to really have an impact, or is it a case where the pricing has already been taken into account?
I think the halving is definitely going to impact the pricing of Bitcoin. And the reason why is that there's currently only 21 million Bitcoin in circulation. And so come April, of that 1 million that's left, there's only going to be 500,000 that can be mined. And what a lot of people may not realize is of these 21 million, roughly 25% of those are lost and or will not be found. And so the ETF only accounts for roughly 4% of the Bitcoin assets that can be mined at the moment. And so with the demand increasing and the supply going down, we expect that the price to continue to go up. And so that's why I think April is going to be a very important month for Bitcoin specifically, because one, you have the halving, so you have a reduction in supply now. But then the other thing is you have in the US where spot Bitcoin is now going to be available for sale to the mass, and so advisors are going to start selling that. So I could see an increase in demand based on that. And the thing is, most of the holdings of Bitcoin ETF or Bitcoin as a whole is 60% individual in retails. And so I think retail investors could see the price going up, and maybe at 100,000 or even higher, they could see that as a point to liquidate and cash in on their Bitcoin. And so I think that with the increased demand in the US coming after the spot Bitcoin has been listed for 90 days, as well as the organic growth, so for instance, if Hong Kong gets a spot Bitcoin as well, the demand is only going to increase because now retail investors can access Bitcoin via an ETFs. And so they feel that it may be a more secure way. And so those holding Bitcoin may realize that the price has gone high enough for them to be willing to sell. So I think April will be a very interesting month as the Bitcoin is halved and as the U.S. is able to add these two retail platforms.
Bloomberg Intelligence ETF analyst Rebecca Sin there. Well, coming up, why a job ad for a supermarket in China is generating buzz about ageism on Weibo. That's next on the China Brief. This is Bloomberg. You're watching The China Show. I take a look at some of the political stories that we're following, and Russia has held a national day of mourning for 137 people killed in Friday's attack on Moscow's concert hall. People across the country gathered in memory of the victims amid heightened security at major airports and railway stations. Russian officials are continuing to suggest a Ukrainian role in the massacre, even after the so-called Islamic State claimed responsibility for the attack. Ukraine says Russian forces launched an aerial barrage on Sunday, including a missile that briefly crossed into Polish airspace, while Kyiv's forces struck 2 Russian ships off the annexed Crimean Peninsula. Ukraine's Air Force Command says it shot down 18 of 29 missiles and most of 28 drones launched by Russia. Poland says it notified NATO allies about a Russian missile that entered Polish airspace for about 39 seconds. The Philippine military says a Filipino civilian boat was severely damaged on Saturday, with some crew members injured when 2 China Coast Guard ships fired water cannons. It says the Chinese ships deliberately targeted the vessel, which was on its way to resupply Filipino troops stationed at an outpost. It is the latest in a series of confrontations between Chinese and Philippine boats in the disputed waterway. Let's get now to our China Brief. It's a look at the stories making headlines in newspapers and online. A commentary in the Economic Daily says China should use fiscal funds more efficiently. That says some local governments continue to face notable funding shortages. The Daily says that governments should use their investments to guide more private capital into sectors that are key to China's economic development.
Yep, certainly a little bit more signs of what this means for fiscal policy. And meanwhile, it's quite interesting. There's a job ad that's been circling around online at a supermarket in China that's generating a lot of buzz here right now. So that's because it comes with an age requirement between 18 to 30 years old, and that's lower than 35, which is sometimes seen as the unofficial cutoff age for potential employers. It also comes, of course, as China grapples with slowing economic growth. There's an aging population, youth unemployment, which we talked about as well, Haidi, time and time again. All right, what does this mean, right? At least one user on Weibo says they're above the age of 35 and they're experiencing issues in job hunting right now, while others note that the so-called lucky ones will have to nail down everything between 20 to 30, including getting a job, getting married, and having a child. Yeah, I'm not a big fan of age limits when it comes to looking for jobs, Heidi. Just goes to show, I mean, I don't know. We should just stay at Bloomberg for some time.
This is giving me anxiety about how much the expectations are piling on in a country where we know the demographics are not in favor, right? People are having less kids in China despite all of the sort of policy support to try and convince them otherwise to build the population. But this is the second ranked post on Weibo at the moment, 74 million views, over 8,000 comments. And it's interesting, Yvonne, you talk about this happens in the context of youth unemployment, right? We know that last summer youth unemployment numbers were hitting record highs. So I don't know, is putting a tight range when it comes to specifications, I guess, one way
to always widen the age net a little bit more, right? Yeah, it's fine. 35 is fine, right? Even higher. Just open up the possibilities.
50 is a new 40, 40 is a new 30, age is just a number, etc.
Of course.
Etc. Let's speaking of numbers, let's take a look at how markets are faring at the moment. And of course, what's in a number? Well, a lot when it comes to trading in the yuan, right? We've seen a bit of relief when it comes to the currency fixing that we got from the PBOC today. But take a look at this chart. It shows that offshore, onshore yuan really seeing a blowout. CNH trading at the cheapest to CNY in just about over a year. But certainly the mechanism when it comes to dollar yuan trading today, really hearing loud and clear that PBOC fixing message to cool your jets a bit. We've seen the yuan crossing dollar China, crosses I should say, for dollar China below 7.2 again. So this is the picture when it comes to trading in the yuan. That stronger fixing that we saw on Friday. We had, of course, a big moves, but certainly this is sending home the message, Yvonne, that PBOC is not letting go of the yuan 20 effect.
Yeah, that's giving a little bit of relief, of course, to some of these yuan traders out there. MSAP, though, we're bouncing off some of the lows here, certainly, but we're still a little bit on the back foot. Not a whole lot of conviction in these markets on this Monday morning ahead of some key data and earnings this week as well. Bloomberg Markets Asia is next. Stay with us.